Welcome back, everyone. Today we're doing a deep dive into Being Right or Making Money
Hmm.
by Ned Davis. And this book really kind of turns the idea of investing success on its head. You know how everyone's always trying to perfectly time the market or like
Mm.
chasing that, hot stock tip? Well,
Yeah.
Davis says that's not the key at all.
Yeah, he really makes this powerful argument for focusing on the things that you can control, like your process, your risk management, and your emotional discipline.
Yeah, it's like he's saying, forget about trying to, predict the future like a fortune teller. Instead, be more like an architect,
Hmm.
someone who builds a solid structure that can, withstand any market storms.
Exactly. And one of the most important cornerstones of that structure, humility, Davis really emphasizes just how complex the market is. You know, just think about it. How many times have you been absolutely sure that a stock was going to go up and then watched it completely plummet?
Oh, so many times.
Oh,
Don't even get me started. I remember this one time I bought a tech stock based on like a guaranteed tip from a friend. Let's just say I learned my lesson the hard way.
yeah.
But Davis's point about the market's unpredictability, that really resonated with me.
Yeah, and he dives deep into how all these countless factors influence the market, which makes, perfect predictions virtually impossible. So instead of chasing those predictions, he advocates for this really disciplined, rule-based approach.
So it's less about intuition and more about having a clear set of instructions for navigating the market. Is that what you're saying?
Exactly. Think of it like a pilot using a flight plan. They don't just wing it. They have very specific procedures for takeoff, navigation, and landing. Davis is arguing that investors need a similar plan, defined entry and exit rules, position sizing guidelines, and critically risk management parameters.
That makes a lot of sense. But what about those times when your gut is just screaming buy or sell? How do you stay disciplined when your emotions are running high like that?
That's where Davis's emphasis on data-driven decision-making comes in. He urges investors to really rely on historical data and empirical evidence, almost like creating a roadmap based on past market behavior.
So instead of trusting your gut or chasing the latest hot tip, it's about looking at the hard numbers.
Exactly. It's about removing those emotional biases that we all have as humans.
Hmm.
I even got caught up in the hype around a certain electric vehicle company once. Everyone was talking about it and the stock was soaring, but I completely ignored the warning signs in the company's financials. Just got swept up in all the excitement.
Oof, I can see how that would be a recipe for a disaster.
It was. It really was. But that experience taught me a valuable lesson about sticking to objective data, which is exactly what Davis advocates in the book.
It's like having that voice of reason in your head saying, hold on, let's look at the facts before jumping in head first.
Exactly. Now, even with the best data and a solid plan, risk is inherent to investing. And that's where Davis's focus on risk management becomes crucial.
Yeah, and he's adamant that preserving capital is more important than maximizing gains. Why is that?
Well, imagine this. Winning big on a few trades and then losing it all on one bad bet. That's why Davis stresses the importance of strategies like stop-loss orders. Think of it like an insurance policy for your investments.
So if a stock drops to a certain price, a stop-loss order automatically sells it, limiting your potential losses.
Exactly. It helps you sleep better at night, knowing you have a safety net. And then there's careful position sizing, which basically means not putting all your eggs in one basket, so to speak.
It's like diversifying your portfolio, but on like a trade-by-trade basis. You're not betting the farm on any single stock,
Yeah.
even if you're super confident about it.
That's the idea. It's about controlling that potential downside, no matter how great a stock looks.
Okay, that's all starting to make sense. Now, one of the most memorable parts of the book for me was his 3 don'ts of investing. I even wrote them down.
Oh, those are classics. They're so simple, but so powerful.
The one that really stuck with me was don't fight the Fed.
Yeah.
It made me realize how much I was overlooking the impact of monetary policy on my investments. You really have to adapt to their actions, don't you?
Absolutely. Trying to outsmart or predict the Fed is just a losing game, especially in today's market environment. It's so volatile.
So it's like understanding the rules of the game before you start playing.
That's exactly. It's about recognizing the power of the Fed and then positioning yourself accordingly. It's interesting how Davis connects those don'ts to this idea of crowd behavior. He argues that understanding the psychology of the crowd can be just as important as, understanding the fundamentals of a company.
Oh, yeah. That's something I've always struggled with. Sometimes it feels like everyone's jumping on the same bandwagon, and I'm
Yeah.
left wondering if I'm like missing something.
Davis actually says that those moments of everyone's doing it can be really insightful. His research has actually found that crowds are often right at the very beginning of a major market trend.
So if there's like a surge of excitement around a particular sector, like let's say renewable energy or AI, that could actually be a good sign to get in early.
It can be, especially if the fundamentals support, the enthusiasm. It's like the crowd is collectively sensing an opportunity, even if it's not fully reflected in the data yet.
But you said earlier that the crowd can also be wrong. So when does that like collective wisdom turn into a herd mentality?
It's often in the middle of a trend. Once that initial excitement has kind of worn off and fear and greed start to take over. Remember that electric vehicle stock I mentioned? Well, after that initial surge, the price just kept climbing even though the company wasn't meeting its production goals.
So the crowd was so caught up in the hype that they completely ignored those warning signs.
Exactly. And that's when you need to be extra cautious. Davis points out that in these situations, it's often the contrarians who end up making the most money.
It's almost like being a detective, right? Looking for clues that the crowd might be overlooking.
Exactly. It's about being able to detach yourself from that emotional roller coaster and assess the situation objectively.
That sounds incredibly difficult, especially when everyone around you is shouting, buy, buy, buy.
It is. It really is. That's why having a well-defined process is so important. It acts like a guardrail, keeping you on track even when your emotions are running high.
Yeah. It's like having that little voice in your head reminding you to stick to the plan, no matter what the crowd is doing.
Precisely. And that plan should include not only your investment strategy, but also a really clear risk management approach. Because even if you're a master at reading crowd behavior, there are always going to be unforeseen events.
Right, like that sudden market crash in 2020 that no one saw coming.
Exactly. And that's why tools like stop loss orders and diversification are so important. They can help you protect your capital even when you know the unexpected happens.
It's all about having that safety net, regardless of what the market throws at you.
Now, one of the things I appreciate about Davis is that he acknowledges that the market is constantly evolving. He doesn't claim to have a one-size-fits-all solution.
So it's not just about setting a plan and then forgetting about it.
Not at all. He stresses the importance of being adaptable and adjusting your approach based on, the prevailing market conditions.
So like a surfer adjusting their stance based on like the size and shape of the wave.
Exactly. He talks about how different indicators and strategies might be more effective in bull markets versus bear markets versus sideways markets.
It's like having different tools in your toolbox for different jobs.
Precisely. You wouldn't use a hammer to screw in a light bulb right. Well, you also shouldn't use the same investment strategy in every market environment.
Okay. I'm starting to see how all of this fits together. You need a solid process. You need to understand crowd behavior. And you need to be adaptable. But how do you actually put all this into practice?
Well, that's where the art and science of investing come into play. There are all sorts of tools and techniques that investors use to analyze data, identify trends, and make informed decisions. But one of the key takeaways from Davis is that it's not about finding like the perfect system or indicator. It's about finding what works for you.
So it's about experimenting,
Yeah,
testing different approaches, and seeing what resonates with your own personal investing style.
exactly. And it's also about, being willing to learn and adapt as the market changes. The most successful investors are those who are constantly learning and refining their approach.
This is all starting to make a lot more sense. But I imagine it can be pretty overwhelming for someone new to investing, trying to learn all these different techniques and everything.
It can be. It really can. And that's why Davis suggests starting with the basics. Don't try to do everything at once.
Yeah.
Focus on mastering one or two key concepts at a time, and then gradually build your knowledge and experience.
And there's so many resources available these days to help people learn more about investing.
Right. Oh, absolutely. There are books, websites, courses, even investment clubs where you can connect with other investors and share ideas.
I'm starting to feel a lot more empowered just thinking about all the tools and resources that are out there.
That's the spirit. But before we get too carried away, I think it's important to remember that investing always carries some level of risk.
Right. No matter how much data you analyze or how sophisticated your strategies are, there's always that possibility that the market will move against you.
Exactly. That's why having a solid risk management plan in place is so crucial. And that's one of the most important messages that Davis emphasizes throughout the book.
Speaking of key takeaways,
Mhm.
what are some of the things you hope our listeners will remember from this whole discussion?
Well, I think one of the most important points is that successful investing isn't about being right all the time. It's about having a sound process, managing your risk, and being adaptable to changing market conditions.
And about using data to drive your decisions rather than letting your emotions take over.
Exactly. And it's also about understanding crowd behavior and recognizing, when the crowd might be right or wrong.
This has been a really enlightening conversation. I feel like I've learned so much.
Me too. And I hope our listeners have as well. We've covered a lot of ground today, from the importance of having a process to the nuances of crowd behavior to the power of data-driven decision making. But there's one more crucial aspect of Davis's book that we need to delve into before we wrap up.
Oh, and what's that?
He dedicates a significant portion of the book to discussing the role of the Federal Reserve, or the Fed, in influencing the market.
Oh, yeah. Don't fight the Fed. One of his famous don'ts.
Exactly. He really emphasizes that understanding the Fed's actions and how they impact the market is absolutely crucial for any investor.
It's funny you mentioned the Fed because I was reading that story in the book about that hedge fund manager, the one who was absolutely convinced that interest rates were going to stay low.
Oh, yeah, I think I remember that one. Didn't he, bet big against rising rates and then end up losing a fortune?
He did, yeah. And Davis uses that example to illustrate how even the smartest investors can get blindsided if they misjudge the Fed.
Yeah.
It's a powerful reminder that we're not just playing against other investors. We're playing against this massive force that can move markets with a single announcement.
Exactly. And the Fed has so many tools at its disposal, interest rates, bond buying programs, even just their words, that they can send markets soaring or crashing. Davis argues that understanding how these tools work and how the Fed uses them can give investors a real edge.
So it's not just about reacting to the Fed's decisions after they've been made. It's about trying to anticipate their moves.
Precisely. Davis talks about carefully reading the Fed's statements, their speeches, and their economic projections. It's like learning to speak their language, deciphering those subtle clues they're giving about their future plans.
So you almost have to become like an amateur economist, keeping tabs on things like inflation reports and employment numbers, because those are the signals the Fed is watching too.
Oh, yeah.
Exactly. It's all about connecting the dots between economic data, Fed policy, and market movements. It's a complex puzzle, but the more pieces you can fit together, the clearer the picture becomes.
But even with all that analysis, Davis admits that the Fed doesn't always get it right. There are times when their policies backfire or have unintended consequences.
He's really careful to remind us that don't fight the Fed doesn't mean blindly following their lead. It's about recognizing their power, but still maintaining your own independent judgment.
So you have to find that balance between being aware of the Fed's influence and then doing your own due diligence. It's a lot to juggle, which is probably why Davis dedicates so much of the book to those specific indicators and models.
Ah, yes, the practical tools. He doesn't just leave us with these abstract concepts. He gives us concrete ways to actually apply his ideas. Remember all those different indicators we talked about? Tape indicators, monetary indicators, sentiment indicators.
And economic and valuation indicators. It felt like you were uncovering a whole secret code to the market.
That's a great way to put it. Davis basically hands us this decoder ring based on years of research to help us make sense of all the market signals.
Okay, so let's say I'm trying to get a handle on the short-term mood of the market. Which of those indicators would be most helpful?
Well, for a quick pulse check on sentiment, the put-call ratio is a classic. It tracks the ratio of put options, bets that a stock will go down, to call options, bets that a stock will go up.
So if the put-call ratio is high, that means more people are betting on a decline, which suggests fear in the market.
Exactly. And conversely, a low put-call ratio suggests optimism. Davis cautions against using any single indicator in isolation, but it can be a really helpful starting point.
What about for a longer-term view of the market? Which indicators would be the most valuable there?
That's where those monetary indicators come in, particularly the yield curve. Remember we talked about how the shape of the yield curve can signal investor expectations about future economic growth and inflation?
Right. Like a steep yield curve is generally a positive sign, while a flat or inverted yield curve can signal trouble ahead.
Exactly. And Davis believes that understanding the yield curve can help you position your portfolio for long-term success. But he also emphasizes that no single indicator is foolproof. You have to consider multiple data points and use your own judgment.
It's like being a detective. gathering clues and piecing together a story.
I love that analogy. And Davis provides all the tools and the frameworks you need to become a market detective.
Yeah, this has been an incredible journey through being right or making money. I feel like I've gained a whole new perspective on investing. It's not about gambling or trying to predict the future. It's about building a solid process, managing risk, and embracing a data-driven approach.
And most importantly, recognizing that you don't have to be right all the time to be successful in the market. What you need is a disciplined approach and a willingness to adapt as the market changes.
Davis has given us so much to think about. As we wrap up this deep dive, what's one key takeaway you'd like our listeners to walk away with?
This might sound simple, but it's profound. Focus on what you can control. You can't control the market's ups and downs, but you can control your emotions, your risk, and your process. Master those, and you'll be well on your way to achieving your investing goals.
That's a perfect note to end on. Thanks for joining us on this deep dive into the world of investing with Ned Davis. We'll see you next time.